Imagine a straight line, right?
Right.
A line connecting a 4,000-year-old clay tablet in ancient Mesopotamia.
Right, the early days of ledger keeping.
Exactly. Connecting that straight to, a modern AI black box that just approves $1 million loan in a millisecond.
That is quite the jump.
It is. But today, we are following that exact line directly into the heart of the modern banking sector. We're specifically looking at a Brazilian digital system settling tens of billions of transactions a year and really uncovering the hidden multi-billion-dollar risks that are just lurking in the system right now.
Yeah, because it's a massive structural shift. We are looking at the underlying mechanics of the money you use every single day. And, the friction between the legacy systems that built global finance and this invisible architecture trying to replace it.
I am your host, as always. Here is your resident curious knowledge seeker, and sitting across from me is our expert, ready to help you connect all these dots.
Always glad to be here.
And just for the record, today is Wednesday, June 24th, 2026. The research and data collection we're diving into is actually finalized just this month, June 2026. You are tuned in to Macroeconomy AI, and the title of today's deep dive is The Banking Sector.
And I gotta say, there is a lot to unpack in this latest data, especially regarding how systemic risk is really mutating right now.
Oh, absolutely. But before we jump into the deep end, I want to quickly thank all of you watching and listening. Please, drop a comment, share this with someone who loves a good analytical deep dive. Your engagement is really what keeps us going.
It really does.
And, of course, a quick word from our sponsor,
Channel.
Macroeconomy AI, bringing a compilation of analyses and news on macroeconomics, technology, and artificial intelligence. If you want to really understand the forces shaping our financial future, make sure you check them out.
All right, so let's get into the foundation. To truly grasp the digital transformation happening right now, you have to look at the history, right? The historical crises that actually forced the banking system to build the specific guardrails we see today.
Because banking is ancient. I mean, we mentioned the clay tablets in Mesopotamia. But the mechanics of scale, they really began later, didn't they?
They did, yeah. If you jump forward to 1397, you see the Medici family in Florence.
Oh, right.
They founded what was effectively the first multinational bank. They had branches in London, Rome, Bruges, and they pioneered the bill of exchange.
Which is a huge deal, right?
It was a massive conceptual leap. It meant you could transfer value across borders without, physically moving a pile of gold on a carriage through bandit territory.
Yeah, that sounds like a logistical nightmare.
Exactly. It was the birth of true international financial intermediation.
But the larger the intermediation, the larger the potential collapse. I mean, look at the 1929 market crash. That wasn't just a stock market event.
No, not at all.
It was this violent contraction of credit that triggered bank runs and almost destroyed the banking system itself.
And that trauma led directly to the Glass-Steagall Act in 1933 in the U.S.
Right.
Structurally separating commercial banking from investment banking, mostly just to protect consumer deposits. But decades later, when deregulation unspooled some of those protections, the
system got highly leveraged again.
Exactly, culminating in the 2008 global financial crisis.
Which really exposed the fragility of the shadow banking sector. The Lehman Brothers collapse just contaminated balance sheets globally. But I want to zero in on the specific data we have today, which focuses heavily on Brazil.
Yeah, the Brazilian market is a fascinating environment.
It completely is.
Yeah.
Because its history created a modern structure that is incredibly resilient, but highly concentrated.
Yeah.
And it actually starts with a royal escape.
Right. In 1808, the Portuguese royal family literally fled Napoleon's invasion and arrived in Rio de Janeiro.
Talk about a dramatic start.
Yeah. And Dom João VI almost immediately founded the first Banco do Brasil. That established the first banking institution in South America. But the modern era of Brazilian banking really begins much later.
1964, right?
Yeah.
With the creation of the Central Bank of Brazil.
Exactly, which set the stage for the decades that I think are absolutely vital to understand. The hyperinflation era.
Oh, man. This is where Brazilian banks learn to survive and honestly profit in a completely chaotic macroeconomic environment.
Yeah, during the hyperinflation era, banks relied on a model called inflationary floating.
Right. And for you listening, I think the best way to visualize this is an incredibly lucrative treadmill.
A treadmill? I like that.
Yeah, like during hyperinflation, banks didn't have to actually bank.
No, they didn't.
They didn't have to assess credit risk or lend money to businesses to make a profit. They just put consumer deposits on this inflationary treadmill. taking money into checking accounts, paying the consumer zero interest, and immediately parking that cash in overnight government bonds.
Bonds that were paying out astronomical inflation-adjusted yields.
Exactly. The treadmill did all the heavy lifting. They were just running the machine.
And capturing that massive spread without doing any real traditional banking intermediation created incredibly bloated institutions. So when the Plano Real was introduced in 1994 and inflation died almost overnight.
The treadmill got abruptly unplugged.
Completely unplugged. Suddenly, these banks had to actually figure out who was a good credit risk.
And spoiler alert, they were terrible at it.
They were awful. The 1994 stabilization forced a massive wave of bankruptcies. Huge institutions failed because they had literally forgotten how to manage real credit risk.
Wow. So the government had to step in.
Yeah, with bailout and restructuring programs like PRER to prevent a total systemic collapse, they basically absorbed the toxic assets of failing banks to facilitate mergers with healthier institutions. It forced a brutal, rapid consolidation of the entire sector.
Which perfectly explains the market structure we see in the 2024 data. The Brazilian market is highly concentrated.
Very much so.
I mean, the top 4 banks sold 57.9% of all credit operations. And state-owned banks carry massive structural weight. Like Caixa Econômica Federal basically dominates the entire housing sector.
And Banco Brazil dominates agribusiness.
Right, because state-owned banks in Brazil operate in these directed credit segments. They have access to regulated, cheaper funding conditions that private banks simply cannot replicate.
Which locks in their dominance in those specific sectors and creates a very unique competitive landscape.
But wait, everyone talks about the digital wave and fintechs disrupting the old guard, right?
That's the popular narrative.
But if the top 4 banks hold nearly 60% of the credit, is this oligopoly actually being disrupted, or is it just changing shape?
Well, if you look at the central bank's RC4 metric, which is what measures the concentration of those top 4 concentration in credit operations, it's actually slightly up since 2019.
Wait, really? Up?
Yeah, sitting right at that 57.9% mark in 2024. The headline number suggests the model is totally fine.
Up. Despite hundreds of fintechs entering the market over the last few years.
Right. The overall concentration is up, but the strategic insight here is in the margins. Competition is genuinely increasing in specific, highly profitable niches.
Okay, like what?
In corporate working capital, for instance, the concentration dropped significantly. The monolith isn't shattering, but its edges are facing fierce competition.
And high concentration usually translates to high profits. Looking at the preliminary data for 2025, the banking sector showed a staggering net profit of 255 billion reais.
That's a huge number.
With a 16.76% return on equity.
But you really have to view that 16% ROE through the lens of the macroeconomic environment.
By the way, interest rates.
Exactly. The SEEK-based interest rate sat at a punishing 15% from June 2025 all the way to March 2026.
15% base rate.
Yeah, that was the highest level since 2006. And by June 2026, it had only dropped slightly to 14.75%.
Borrowing money at a 15% base rate is brutal for anyone. But the spread? The difference between the bank's funding cost and what they actually charge the consumer is where the numbers get truly wild.
They do.
The data shows revolving credit card rates surpassed 400% a year.
400%.
And overdrafts crossed 100%.
And those figures routinely shock international observers. But the spread isn't just pure, unadulterated profit.
No.
No, there's a complex mechanical reason why the cost of borrowing is so staggering in Brazil.
Okay, I think of the Brazilian bank spread like an incredibly expensive toll booth on a major highway.
Go on.
So you, the driver, pull up, and you are furious at the price, right?
Yeah.
But the toll operator points at the road ahead and says, look, I have to charge you this much. I pay a massive 20% tax rate compared to the 9% everyone else pays. The government forces me to lock a chunk of my cash in a vault where I can't even touch it. And that's before we even factor in all the thieves hiding in the bushes down the road.
That's a brilliant way to put it. Let's break down those costs. First, that 20% tax rate is the CSLL, which is a social contribution tax heavily levied on the net income of financial institutions.
So they're taxed double right out of the gate.
Pretty much. Second, the compulsory deposits. The central bank forces banks to lock up a significant portion of their deposits at the central bank itself.
Why?
It drains liquidity from the market, which artificially drives up the cost of the funding that is actually left to lend.
Wow. And the thieves in the bushes represent the default rate, I assume.
Exactly. Structurally high default rates compounded by a painfully slow judicial system for executing guarantees.
Meaning, if someone doesn't pay, good luck getting your money back.
Right. If someone defaults on a loan in Brazil, recovering that collateral takes years and costs a fortune in legal fees. Because recovery is so inefficient, banks price that systemic risk into the spread for every other consumer.
So if the toll road is that heavily taxed and potholed, obviously the market is going to try and build a bypass.
Absolutely.
And that is exactly what the digital onslaught over the past few years has been. A high-speed rail built right next to the legacy toll road.
And that high-speed rail is Pix.
Oh, Pix is incredible.
Launched in November 2020, its adoption curve is just historically unprecedented.
Yeah.
We saw 63.8 billion transactions in 2024 alone.
Billion, with a B.
Yeah, a 52% jump from the previous year.
It completely eclipsed legacy wire transfers and traditional invoice slips, what they call TEDs and Bolitos down in Brazil.
It did.
But the trend to watch right now is contactless Pix using NFC technology. The growth here is literally a vertical line. It went from just 95,000 rays in volume in July 2025 to over 568 million rays by January 2026.
And the mechanism driving that growth is purely the cost structure. For merchants, receiving a Pix payment costs them about 0.3%. Wow. Contrast that with receiving a credit card payment, which averages around 2.34%.
That's a massive difference for a small business.
Exactly. Why would a merchant accept the expensive legacy infrastructure when the alternative costs a fraction of the price and settles the funds instantly?
They wouldn't. And riding this digital wave are the fintechs. Like Nubank hitting 114 million global customers by the end of 2024.
Making it the largest digital banking platform in the world outside of Asia.
Right. But our sources show the wider fintech sector is actually facing a harsh reality check.
Yeah. We are seeing a severe consolidation phase. The total number of fintechs in Brazil dropped from over 720 down to under 600 by mid-2026.
Wait, really? Why are they suddenly dropping off the map?
Well, the central bank significantly raised the minimum capital requirements for direct credit societies, forcing them to have more of their own cash on the line to absorb losses.
Oh, okay.
Furthermore, fintechs have massive technological advantages in customer acquisition, but severe structural vulnerabilities when it comes to credit risk.
Meaning they are brilliant at building seamless, beautiful apps, but terrible at getting their money back in a high-interest environment.
Precisely. The data reveals a massive discrepancy. The default rate for fintechs sits around 9.5%.
9.5?
Yeah, compared to the traditional banking average of 3.5%. When your base interest rate is 15%, a 9.5% default rate will burn through your capital reserves incredibly fast.
Which really makes me question the popular narrative. We always hear about the death of big banks.
Yeah.
But if fintechs have a near 10% default rate and are bleeding cash, aren't the big banks just absorbing these tech shocks and waiting for the smaller players to run out of runway?
That's a solid read. The incumbents have fortified balance sheets and decades of proprietary credit modeling experience.
Right.
Pix did level the playing field for payments, and it cost the big traditional banks an estimated 1.9 billion reais in lost tariff revenues in 2025 alone.
That's not a small number.
No, they're bleeding fee revenue, but they are adapting. The smaller players are finding out that lending money is the easy part. Collecting it is a very different business.
So if fintechs are struggling with defaults and big banks are absorbing the fee losses, where is the actual frontier of the banking war right now?
According to the data, it's happening where the consumer can't even see it. Central bank digital currencies, or CBDCs, are a prime example.
Right. And the Brazilian project, Drex, underwent a quiet but massive pivot in 2025 and 2026.
It did.
Because originally, Drex was pitched with this grand vision of a public blockchain for consumers, right? Tokenizing everything for the everyday person.
Yeah.
But they completely abandoned that model.
Because a public blockchain was a logistical nightmare for a central bank. You can't have every node seeing every consumer transaction due to privacy laws. And the zero-knowledge proofs required to encrypt that data just weren't scaling fast enough to handle the volume of a 200 million-person economy. So Drex was retooled into a highly specialized back-office utility.
Right.
Its primary function now is the reconciliation of encumbrances.
Which sounds incredibly dry. But the mechanics behind it are actually crucial for systemic stability, aren't they?
Oh, it fundamentally changes bank liquidity. Reconciliation of encumbrances basically means ensuring that an asset like a fleet of vehicles or a piece of real estate used as collateral for a loan isn't double booked.
Ah, I see.
It stops a corporate borrower from using the exact same asset to secure 3 different loans at 3 different banks. Drex settles this via programmable money instantly, removing massive shadow risks from the system.
What I find fascinating is the international contrast here. While Brazil is building this programmable state money for institutional efficiency, the U.S. took the exact opposite path.
They really did.
Yeah, on January 23, 2025, an executive order was signed in the U.S. strictly prohibiting federal agencies from establishing or issuing CBDCs.
It highlights a deep ideological divide globally. The U.S. is explicitly rejecting CBDCs at the federal level due to concerns over surveillance, privacy, and central control of the money supply.
Whereas the Brazilian central bank is just embedding it directly into the interbank plumbing. Speaking of embedding invisible technology into the plumbing, we have to talk about AI. Because artificial intelligence is ubiquitous in banking right now. Fraud detection, risk modeling, customer service.
Oh, it's everywhere.
But the central bank has flagged 2 massive risks, the first being the black box problem.
Right. When an AI denies a business a line of credit, regulators require an explanation. But with advanced neural networks, the bank looks at the code and realizes no human actually knows exactly how the weights and biases resulted in that specific decision.
That lack of auditability creates a huge regulatory and legal blind spot.
It's a huge issue.
And the second risk is what they call algorithmic homogenization.
This one is scary.
Yeah. If every single bank uses the exact same third-party AI API to decide who gets a loan, it's like an entire fleet of ships using the exact same flawed GPS system.
That's a great way to put it.
Right, because if there's a glitch or a blind spot in the training data, they don't just crash individually. They all hit the exact same reef at the exact same time.
It takes an isolated risk and transforms it into a systemic contagion. If a dominant AI model scores a certain type of toxic asset as safe, every bank relying on that model loads up on it simultaneously.
And when reality hits,
The entire sector realizes they hold garbage at the exact same moment.
which brings us to the ultimate nightmare scenarios.
Yeah.
I mean, the system did survive a major hit recently with the 2023 Americanas collapse.
Yeah, a $43 billion real hole in corporate credit.
Massive.
It was a massive shock to the system, specifically to the drawn risk supply chains.
Meaning the web of suppliers who had already drawn down credit based on invoices Americanas was supposed to pay. When the retailer collapsed, those suppliers were instantly over-leveraged.
Exactly, and the banks didn't just write it off. They had to pull from their capital reserves and aggressively provision for those losses, taking a direct hit to their quarterly profits to absorb the drawn risk.
But the system held.
The system held.
But the sources point to a much darker tail risk, looking forward to the 2026 to 2028 horizon. A sovereign fiscal shock or fiscal dominance.
And this is the mechanism that keeps regulators awake at night. Brazilian banks hold a massive amount of government debt on their balance sheets.
Right.
If government spending becomes completely unsustainable and the global market loses faith in the state's ability to service its debt, the value of those government bonds plummets.
And because the banks hold all those bonds and rely on them for their foundational liquidity.
The banks get dragged down with the sovereign. The biggest threat to the Brazilian banking sector isn't a new digital app stealing checking accounts. It is the deeply intertwined relationship between high government debt, persistently high interest rates, and the heavily exposed balance sheets of the major banks.
Wow.
If the sovereign fails, the banks fail.
So what does this all mean for you, the listener?
Oh.
We've traced the line from ancient clay tablets to AI black boxes, and it leaves me with a final thought for you to mull over.
Let's hear it.
With open finance now allowing full data portability, meaning your financial history isn't locked inside the vault of one legacy institution anymore, and AI making instant decisions behind the scenes, will the bank of the future even be a distinct place we visit or an app we explicitly open? Or will banking simply become an invisible, embedded line of code inside the stores, the software, and the lives we already navigate every single day?
We are definitely moving from banking as a destination to banking as an invisible infrastructure.
Exactly.
And before we wrap up today's analysis, it is essential to formally note that we have been discussing systemic structures and macro trends today. No investment advice was given during this deep dive.
As always, we are committed to providing the exact regulatory context for our discussions. So, as required, please listen to our formal disclaimer. Aviso legal. Este conteúdo possui caráter exclusivamente informativo e educacional, compilando dados, projeções e análises de fontes públicas de mercado. O material não expressa viés ideológico e não constitui recomendação de investimento, consultoria financeira, jurídica ou tributária de qualquer natureza. Projeções econômicas e tecnológicas estão sujeitas a revisões frequentes diante de novos dados e fatos de mercado. Da mesma forma, rendimentos passados não garantem retornos futuros. O objetivo deste espaço é introduzir conceitos e estimular o debate acadêmico e profissional. Decisões estratégicas, financeiras ou patrimoniais exigem análises aprofundadas e personalizadas. Portanto, consulte sempre profissionais e especialistas qualificados antes de tomar suas decisões.
Thank you for navigating this complex landscape with us today. Understanding these foundations and mechanisms is really the best way to prepare for what comes next in the financial world.
That was today's Macroeconomy AI. We'll leave it here. You all stay well and keep an eye out for our new broadcasts. Subscribe to our channel, access the links, and follow Macroeconomy AI on social media.